Hello, and welcome to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Welcome all. Thank you for joining the Mornings with Joel CRE podcast. This is Joel Miller, your guest, or your host rather. Let me get that straight. Our guest is actually another individual that's a guru in tax credits and OZ funds, and I wanted to bring him on today, and that's Stephen Rothschild. Steve, how are you doing today? Good to have you with us.
Thank you, Joel. Appreciate it. Glad to be with you.
Absolutely, absolutely. So you guys are part of the strategic companies. I know your partner, Ricky. I've known him for many, many years, and we're excited that you're part of that team and what you guys are doing. And, just for our audience, introduce yourself as to who you are and why you have this, why should we be listening to you about tax credits and OZs? Obviously, you have a depth of experience in it. So tell us all about that.
Well, thank you, Joel. I am a partner with a strategic group of companies. There's three of us. We have, four lines of business, if you will, where 1031 exchange, which Ricky, and is the expert at that. We have a full tax credit company. We specialize in transferable tax credits, but we also do co-development of low-income housing developments, historic rehab developments, and some renewable energy called solar farm developments that are all associated with tax credits that are part of the capital stack. We are on our second opportunity zone fund. We can explain what that is, but it has to do with capital gains tax.
Right.
And our company is an asset manager of various funds, of which about 75% is vested in real estate. The rest is in what I would say traditional private equity. And I've been around the block. I still think I'm a young guy, but go with some of my real estate, peers, and we all kind of looking a little older these days. But I've been in the real estate business for 35 years, and I've got a fairly extensive and wide experience, and hopefully that could be entertaining for some of your listeners.
All right. Well, fantastic. It's funny you talk about you still view yourself as a young guy. I still do the same. And unfortunately, my kids always remind me that I'm not. So, I tell them I'm always going to be old compared to you, right? So you have to look at it with the right lens.
I think this may be interesting to you guys, and just a little bit about my background, if that will help. So again, I got lucky. I had a father who was a real estate developer out of Chicago. And he got me involved when I was in high school. I mean, I literally would go to meetings with him, and he'd basically say, "Hey, go call this office or, this development over here. We want to know what's going on. So we can get a good market reconnaissance of our prospects for our projects." He was credited for bringing Japanese industry to the United States. I mean, he was literally had a staff of 25 Japanese in his office.
Wow.
So and I enjoyed real estate and wanted to have a good foundation. I think my goal was always to be a developer. I think a lot of people in real estate will say, "Hey, let's go either buy or develop something and own it." So I went to college at University of Vanderbilt University, and had the opportunity while I was, I think I was a senior, and my father knew the head of, at the time, Coldwell Banker Commercial, a guy named Gary Beeben. Interesting name. He was a Heisman winner.
Okay.
And they were opening up a Nashville office, and they were talking and said, "Hey, my son's in Nashville at Vanderbilt. Why don't you call him, see if you need anything?" Well, I was the first hire.
Wow.
And I basically helped set up what they called the data bank at the time. So I kind of did it part-time and learned the ropes a little bit. So as I got out of college, I kind of had my choice of going anywhere around the country with CB Commercial at the time. I ended up going to Atlanta and worked with Cushman and Wakefield.
Okay.
And I became what I call the king of the bees. I did everything that none of the senior guys wanted to do, which was basically being a marketing leasing agent for B properties, subleases, kind of anything that no one else wanted to do. So that kind of got me. I learned a lot. I mean, I got into understanding both sides of the transaction, both from the owner side, but also from the tenant side. And then I did that for about 5 years. I had an opportunity to go work for Prudential, a division of Prudential. And at the time, Prudential was the largest commercial real estate owner in the country outside of the United States government and the Catholic Church.
Wow. And
they were setting up a company. A lot of the insurance companies were doing this. They were setting up these operating companies. People in Atlanta would understand the name Compass. That was a big firm that Equitable formulated. Well, Prudential formed a company that we kind of came up with the name called Premises, which is a play on words. We were a operating company. We went to the board of Pru, and lo and behold, I came home with really representing the Southeast, mainly Atlanta, but we had properties in Florida and elsewhere. So we were kind of asset managers. I was pretty much responsible for marketing, leasing, and asset management. We had a property management division. Well, that lasted for about 4 or 5 years. And then something called risk-based capital came in, where the regulator said, hey, insurance companies really have to be careful with how they own this risk-based asset. And around that time, most of the big institutions had to basically get out of a lot of their real estate. And interesting enough, you think about it, 1994, prior to 1994, there were probably 2, maybe, certainly not as many as 5 REITs in the country. And a guy named Sam Zell, who we just lost in the industry a few weeks ago, decided that he wanted to form a REIT and work the deal out with Prudential. And essentially, they exchanged assets for REIT shares, and Prudential went from, and all of the subsidiaries of that real estate arm went from like 5,000 people to 3 essentially REIT share managers. Sam Zell had all the assets and started, Equity Office Properties. So I was out of a job. And at that time, a guy named Henry Faison was doing some stuff with a building in the perimeter of Atlanta called Concourse. If anybody's been into Atlanta, it's the King and Queen building.
King and the Queen. Yep.
And we were trying to build 2 new properties there on the corner of that asset. TIAA was our owner, and they said, we actually got it, somewhat pre-leased, and we went for approval to get them started. And they said, nope, we got problems. This was around 96-ish, I think, 94, 95, 96, somewhere in that range. They said, we got problems in our real estate, so we're not going to pull the trigger on that. I had nothing to do. So had an opportunity to do what I did with Prudential with a division of UPS. Which is interesting. It was called Overseas Capital Partners. And Overseas Capital Partners was a division of UPS reinsurance company out of Bermuda. And what they did was they formulated a reinsurance company of all the UPS packages. And if you know much about reinsurance, a lot of them are in the Bermuda. And the Capital Corporation was a United States entity that would take that money and invest it in planes, trains, and real estate. And so we set up a company called Overseas Capital Management Company, which I ran.
Okay.
And anyway, that lasted a few years, couple, 3 years. And apparently they didn't set that up really well. And the IRS came after them. And next thing they know, they had to kind of liquidate those assets. And I had an opportunity to go kind of back with my CB world in a way, company called Insignia ESG, which is like the fourth largest real estate operating company in the country, tapped me to run the Southeast for them on their assets side of the house. I did that for a couple of years, and then they merged with CB Commercial to become CBRE, which is now the largest real estate services company in the world. Yeah. When that merger happened, I got squeezed out, and I said, I'm done. I'm going to start my own company, and I became a real estate syndicator and started buying my own assets, and then brought on a partner and friends and family, and then had some institutional investors, and amassed a small portfolio there. Along the way, I got involved in this tax credit business, and that was just a total, happenstance. And it was perfect because as I was raising capital, I was kicked out of just about every institutional, Merrill Lynch and Goldman Sachs and, Bear Stearns. They would kick me out of the office and said, we can't give you our clients. It's called selling away. Well, when the tax credit business came around in Georgia around 2002, the state tax credits, a friend of mine was in that business, and I got into that business, and that allowed me to call these folks and say, hey, I have something you need. I have a way for your clients to save money on taxes. And next thing I know, they're calling me, all of them calling, and I had something they needed. And then that allowed me to have a better relationship with not only the advisors, but the investors themselves. And that's kind of my story.
Wow. So yeah, you've been full circle, and as you mentioned, you've been in the game for a minute. So you've seen a lot of different assets of it, and that's
been a ride.
Thing. Yeah, absolutely. So that's very helpful. And obviously today you're primarily focused on the tax credit business and the OZ fund business. And what I want to do is kind of break this into two parts, because both of them are very significant to our listeners. Let's talk about the tax credit business first. And I'm going to save the OZ business because a lot of people feel that that's kind of died off, but it really hasn't. I want to kind of go into that a little bit as well. But the tax credit business, let's talk about that for a minute. What really is a tax credit for our audience, and how does it apply to what you're doing in commercial real estate? Because most people hear of LIHTC and new market tax credits and all the rest of it, but I'm going to let you explain all of that and in a little bit more detail for us.
Well, I'll do the best I can. It's a little complicated, but I'll do the best I can, and I appreciate that. So our role in the tax credit business, and what really tax credits are, is they're both federal and state incentives that fosters growth in particular industries. Okay, real estate's one of them, and we specialize in what I call transferable tax credits, where a taxpayer, for their income tax purposes, can buy $1 worth of tax credit for something less than $1. Okay, and that money is part of a capital stack of whatever it may be. We just so happen to, we focus on not every single transferable tax credit, but just about. We film and entertainment tax credit business, okay? But when it looks as real estate, low income housing tax credits, okay? Those are both federal and state, if there is a state program. Certainly they're always federal. We're involved in historic renovation, call it, HTC, historic tax credits. Okay. Again, same thing, typically a federal program. Some states have a state program. We're involved in a smaller way, renewable energy, solar farm development. Again, there is a federal I don't know, the last state may have gotten out of it, but there is a federal tax credit there as well. So we kind of have two sides of the game there. We are in that world, we're a little bit of everything. Sometimes we just act as a what I call a syndicator. We'll actually go buy the credits from a developer, and we buy them at a certain peg, or call it basis.
Mhm.
We can wrap them into a fund, and then we go sell them to taxpayers, especially the ones that can apply. Federal credits do not apply to individuals typically, because they're subject to the passive activity rules. If individuals do have passive income, real estate owners, some private equity could be considered passive. They can benefit with a federal credit. Most can't. So federal credits typically are sold to insurance companies, banks, Fannie and Freddie, but state credits are not subject to passive activity. So those are always typically, we like to focus on individuals on state tax credits. So we act as a syndicator where we'll buy those credits from a developer, and we just act as part of the capital stack. They use that money to go build their projects. We are also a co-developer. So we're building our own projects and generating our own credits. And then we have what I call a clearinghouse. And that clearinghouse then acts as the sales function of the transfer, to transfer the credits from the sponsor to the taxpayer. Okay. So again, those are the functions we deal with there.
Okay.
Does that help?
Oh yeah, absolutely. So what I want to do, because mainly the show is focused on real estate. So let's talk about an example, just real quick. Let's say I'm doing a $100 million development project. The equity needed on that deal is, let's say, 40 million. Let's say maybe 30 of that is going to be LP equity, and another 20 has to be wrangled together. All right. So in a tax credit play, let's say if we do have some affordability component as part of this, how much of that 20 million would we be able to apply the tax credit strategy to? Do you normally see? And I know it could be all over the place, but let me get your answer.
Yeah. So interesting enough, we are with 100% in the low-income housing tax credit world. So it's an anomaly. We provide no equity to the table, zero. So the tax credit is the equity. The tax credit investors are the equity into the deals. And typically that can be anywhere from 30 to 60% of the capital stack. All right. The rest is typically bond funding. Okay. And yeah, I mean, that's why people are in the low-income housing development business, is because they're not having to raise equity. The equity is raised through the tax credits. It is 1000% brain damage. There are certain allocations. There's all kinds of rules. There's applications. It's extremely expensive and a lot of upfront pursuit costs to get even awarded those tax credits. And you're playing with, a various tax credit market based on pricing. And a typical low-income housing tax credit deal, you got a 15-year compliance period, but typically you have a 25-year restriction. And again, you are what I call somewhat rent constricted. Okay, you have to be able to provide rents at certain rental rates. So it's an entirely different animal than what I would call a market rate deal. A market rate developer is going to go in, he's going to go raise a bunch of money. He's going to go ahead and find out, who's going to give him the lend, who's going to be your construction lender, who's going to be your perm lender, and you're going to go ahead and you'll have your equity stack, if you will. You'll have your debt, piece. You get the thing built, And, many developers are merchant builders, so they're going to sell that within, I don't know, 3 to 7 years. Okay. And they're going to go get a multiple on equity. All right. Not the case with the low-income housing tax credit deal. The majority of low-income housing tax credit deals, even after the compliance period, are typically redone and put back into the program. The developer, such as us, why are we doing this brain damage? Well, we get a very, very nice, hefty development fee.
Mm-hmm.
We get, there's, a decent amount of cash flow, but you got to remember our cash flow is on zero equity. So you can imagine, what's the return of what's the return?
Infinite.
It's infinite. Okay.
Yeah. Mm-hmm.
There is risk. There's no question about it. There's construction risk, but typically there's no risk. Historically, low-income housing tax credit deals have defaulted I think it's 0.02% of the time historically. They just don't default.
Mm-hmm.
They're typically occupancy rates are somewhere in the 98 percentile. So even in a bad economic time. So and then if you get a big enough portfolio, Joel, I think what you'll see is a lot of affordable housing developers then start various other profit centers. They'll get a property management company going. The property management companies are all regulated. This is a whole fully regulated program, so they have to be specialized. But again, then that allows them to continue to build upon, other profit centers.
Gotcha. Absolutely. What about value add situations? Do you ever run across situations like that where you're getting involved in a value add play and taking it affordable possibly, or doing something in that regard?
Great question. So, there are affordable housing renovations. So I could, so let's, as an example, there's an apartment building down the street. It's 25 years old. It's kind of needs some lipstick and tender love and care. And I can buy it and turn it into affordable with a substantial renovation.
Mm-hmm.
Absolutely. That is not our game. We're ground up.
Mm-hmm.
Have we looked at that game? Yes. But no, we're not in that game. Where we are in the game is we have looked at some of the historic rehab deals.
Mm-hmm.
Where we're not only doing an historic rehab tax credit deal, but we're also putting a low-income housing tax credit component. So we're getting double credits.
So a stackable situation.
Absolutely.
Tax credits, yeah.
Yeah. So when that happens, you can imagine what your capital stack is there. I mean, you're getting two sources of credits. If it's in the state where there's also, two sources of estate credits, you're looking at a substantial amount of your capital stack being brought in by tax credit investors, where your debt component is very small.
Yeah. Very good point. Very good point. That's good to know. I guess I would ask: is it just the business model, or was there a specific reason why you guys didn't go into value add?
Business model. There are some complications on the rehab. Mm-hmm. Of low-income housing. And again, when you talk about the value add, we're really at this point in time staying in our lane on tax credit deals, as opposed to going in on a value add market rate scenario. So Joel, we're not focused on what I call market rate deals. We got to bring in traditional equity and do a value.
Well, I meant actually value add in the affordable space.
Got it. Yeah.
Yeah. Is there any reason why you stayed out of that? Or it could just be your business model?
Yeah, it's mostly business model. I can tell you one of my partners, I've never done it, so I can't tell you, but one of my partners has done it before, and he's always said there's a little bit more risk to it. Mm-hmm. Funny enough. I mean, why? But I think what happens is you got to be really careful with, how your basis is spent, because, a lot of your tax credits are based on your qualified expenditures.
Mhm.
So sometimes it's a little harder to make those deals work.
Gotcha. All right. Well, that's very interesting. In this market, have you still seen a demand for land conservation credits, or is that still on the shelf because of the way the economy is right now?
Yeah, good question. That is 100. Well, from our perspective and what we're seeing, and as you know, we're security licensed, so we're out of that game and been out of that game, and we'll stay out of that game. Is that still a practice? Most of it's been shut down. There still is a way to do it, but we believe that it's even today with the way to do it does not circumvent the valuation scrutiny,
Mm-hmm.
and that the valuation scrutiny has been so severe that it's just we're advising anybody to probably take a breather on that right now.
Yeah, gotcha.
It's unfortunate because the program was a great program. It did conserve a lot of land, and there were a few bad actors out there that kind of hurt the program for everybody.
Yeah, very true. I think that's a very nice politically correct way of saying it, but that's really what happened. I mean, and it became, I guess you could say, closer and closer to the razor's edge, to where you say, you know what, is it worth getting cut? Let me just step off to the side. So
yeah, and the problem with that, Joel, too, is that look, that was kind of the last federal mitigation opportunity. And
Mm-hmm.
and now they've done away with the what they got, a $10,000 deduction. I mean, that's nothing.
Yeah, that does nothing.
So there's really very few places for certainly an individual to hide
Mm-hmm.
on their federal taxes.
Yeah. Well, it waits to be seen if the economy really goes the other way again. We have a repeat of 09, 08, 09, and 10. What might happen, but time will tell. Right. We'll just have to kind of wait and see.
Absolutely.
Yeah. So let me do this. We're kind of halfway through. I want to open up the line for questions. If you have any questions, you can come in and raise your virtual hand, or put those in the chat, and we'll make sure that we get those over to Steve as well. So we do appreciate that information from that standpoint. As regards your tax credit development deals, what would be a typical size, that you guys would get involved in?
On a historic deal, I would say that we're probably the two deals we're under construction with one deal, finished up another deal, one in Duluth, Minnesota. Just by the way, a really cool deal was the old Duluth Board of Trade building, like 250-year-old building where all of the commodities in the Midwest would go to Duluth, and they put them on ships, and they would send these commodities through the Great Lakes.
Okay.
And this building has, on the top floor, 8th floor, is a trading floor.
Okay.
And again, you got to think about 250 years ago. I mean, there's these teeny little phone boxes and phone booth boxes, and people are writing in chalkboard on the it's just cool as hell. Unfortunately, funny enough, with a historic rehab, we can't do much of it. You can't change it. So it's been kind of hard to lease. We use it kind of as a multi-purpose room. But and we have another deal in Peoria, Illinois, the old Churchill drug building. Both of those deals, I think, were somewhere around $25 million. But I would say that they were relatively, I wouldn't say large, but they were, mid-size. And we would certainly be willing to do something smaller, but probably not smaller than $12 or $15 million. Again, a lot of brain damage, and it's got to be big enough for all of the various call it advisors that you have to be, that has to be a part of it,
Yeah. Well, that's why I was asking, because some of these smaller deals is just too fee intensive for the numbers to actually pencil. So you have to get some type of scale in order to make that actually work. So
absolutely. On the low income housing side, we just closed a deal in Panama City. I think it was 35, maybe $40 million. They're $35 million. And then we have two South Carolina deals that are 65 million. Can't remember what. So we have another deal somewhere. I can't remember. So yeah, we're, I don't think we're going to do deals bigger than 65 million, but I would say that we're in that range of 20 to 65 million.
Okay. All right. Well, that gives a pretty good idea as to what's going on from that standpoint. All right. So let's pivot a little bit. I wanted to talk about Opportunity Zone Capital as well. It was the buzz, roughly, I don't know, 6 years ago. It became very popular, maybe 5. And then all of a sudden, it's just everything kind of got quiet. But what are you seeing out there right now as it relates to capital availability and investors wanting to put money into OZ funds? I guess we could start there and kind of go around the barn with this. What are you seeing?
So what we're seeing is that there was, it's kind of ebb and flows, Joel, frankly. We saw what you're saying. We saw a little bit of the market was putting around for a little bit. Actually, within the last, this year has been pretty strong.
Okay.
And I can tell you why. I think that with what's going on in the capital markets, a lot of folks saw what was going on in the capital markets, and we have seen a decent amount of business sales. And with business sales, if there's a low basis, people have capital gains. Okay. Yep. And people are looking at, again, there's no place to hide. So people are looking at ways that they can go ahead and use this Opportunity Zone Fund as a tax advantaged investment. And if they're talking to various advisors, I always look at somebody, again, I got a quick story. So
please.
We had, when it first came out, we were one of the first funds in the marketplace nationally. And, I remember like this was yesterday, and one of our first potential investors came in from 2 different advisors, came in from their money manager and their CPA, and they came into the office. I think this was around beginning of 2019, maybe the end of 18. And if you remember, the law came into effect on the 2017 Tax Cuts and Jobs Act, starting in January 2018, but we didn't have regs until literally the following year.
Yeah, it took a while.
So no one knew what was going on. And matter of fact, even the 8,700 Opportunity Zone areas were not even identified until 6 months later. So anyway, these guys came in the door, and they came into my conference room, and I'm looking across the conference room, and I mean, they look like they were about 5 years old. I mean, they were young guys. Not saying that I've seen a bunch of guys that are 60 that look like 5 years old, but they were really young. And I asked them, I said, well, tell me, how did, what happened? And they said, well, we sold our company. So what kind of company? They said, it was a tech company. I said, okay, well, what'd you sell it for? We sold it for $25 million. I said, great. What was your basis? They said, nothing. I said, so you got roughly $25 million worth of capital gains.
Yeah.
Yes. And I said, well, it's okay.
It's a little bit of a problem.
So what do you want? Yeah, no problem. What do you want to do? Well, we want to put $25 million into your fund. And I went, whoa. I said, I'd love that money. I appreciate it. Thank you. But if I took it, I said, without knowing a little bit more and talking to your advisors, I probably wouldn't sleep at night. So I asked him, I said, give me an idea of what you guys have in your investment portfolio. Is this 25 million, 10% of your net worth? And they said, no, it's all of it, 100%. I said, all right, let me tell you how I would say that you need to talk to your advisors. And again, I'm not advising. I said, look, I'm not advising you, but this is how I look at the Opportunity Zone Fund. this is a financial plan opportunity. If they had $1 billion and they made a $25 million capital gain, fine, bring it all in. Okay. But in their case, I said, there's risk to it. I said, it's a 10-year hold. And why don't you just take a percentage of your $25 million and put it into our fund and forget about it for 10 years, like a Roth IRA. And let's just forget about it and hope in 10 years that it's going to go do really, really well. And you got a nice pop, a tax advantage pop. And so I think what's happening in that story is a lot of people are now looking at it that way. They didn't really quite understand what the program was about. And they now realize they can take a allocation of their capital gain and they can use this as a kind of a put it away financial plan tool. And again, not think about it for 10 years. That's number one. Number two is we play off of our 1031 exchange practice a lot with the opportunity zone funds. I would say that more than half of our 2 opportunity zone funds money has come from 1031 exchange folks. And there lies that when the real estate market has been so frothy, and it really still is, even though we have not really seen the pricing come back, even though all the capital markets are locked up. So, let's just say that you had a property that you put $2 million in and you just sold it for $10 million. Okay. You've owned it for, 20 years. You got an $8 million capital gain. Here's the great thing. You can take your $2 million of your original investment and put it in your pocket. Okay. You can take, let's just say, you know what? I'd worked my ass off for 20 years on this property. I deserve some of that. And I'm going to go ahead and pay the tax and I'm going to have fun and I'm going to just enjoy it because I've worked my ass off on that. So let's just say they do that of the $8 million, they do that with $4 million. Okay. Now they can take $4 million or less than $4 million, $1 million, whatever they want to do. Or they can take $4 million, put $1 million in our fund, $1 million in another fund, and 2 other funds, and use that as again, financial planning tool. So we're having more of those kind of conversations, Joel, with blown exchanges because people cannot find a replacement property that they believe I always tell people on a 1031 exchange, and this is for Ricky, don't let the tax tail wag the dog. Why come out of a real estate deal that you worked your ass off and done so well with and blow it just because you're going to save on tax on a stupid deal? Because you're trying to save tax.
Right.
So anyway, we've seen a decent amount of money.
Let me add some context to that because you make a very valid point. So a person might be coming out of a deal, as you mentioned, they have capital gains. They say, well, I'm going to 1031 this, and there's a expiration date on that, right? There's a clock running. It's like being in a taxi, and the meter's running, and it's like, okay, I got to find a deal. Okay, I'll just take this one and throw my money in there to save taxes when that might not actually be that great of a deal. Right. And that's pretty much what you're saying in this.
Yeah, there's some optionality. Okay. They can go do the one deal. There's something called a Delaware statutory trust, which is, which qualifies. And then whatever money that they don't put into the exchange or nothing into an exchange. So you got 45 days to identify with a 1031 exchange. You can blow up that exchange in the day 45. Okay. As long as it's before 5 o'clock. Okay. You get all your money back the next day. Okay. And you have 180 days, just like a 1031 exchange, to put your money in an opportunity zone fund. Okay. from the date of liquidity event. So after day 45 on your 1031 exchange, your money has to stay with a qualified intermediary for 180 days. If you do not do the exchange and you blow it up, you cannot get your money after the 45th day until the 181st day. All right. Which is weird because you got 180 days to go put your money in an opportunity zone fund. So you have basically a 1-day float So you got to go find money or borrow money or whatever it is. Make your money. It can be commingled. It doesn't have to be that it was labeled that this money came from here. And you can go ahead and make your investment in an opportunity zone fund in day 180, and then get your money from your blown 1031 exchange in day 181.
Mm-hmm.
Okay, so you have a 1-day float. And again, an opportunity zone fund does not have safe harbor. So you go ahead and you sell your company, the money goes into your bank account. That's fine. That's fine. It could be commingled funds. Doesn't have to be safe harbor funds.
Gotcha. Well, that's good to know from that standpoint. As regards the percentage of affordability in some of the projects that you guys get involved in, are they usually 100% affordable? Are they a percentage like 20 and above, 50 and above? What generally does that percentage look like?
Yeah, great question. We work off of the programs at the time. So most low-income housing tax credit deals are at least 80% affordable.
Mm-hmm.
Now there are certain thresholds. So you can do a percentage of whether it's 60% AMI or 80% AMI. So there's various qualifications based on how many of those units you allocate to those various thresholds, and
Right.
then that allows you to be able to essentially be awarded the credits. And some jurisdictions will require you to have certain allocations.
Okay. All right. So it could be tiered. Just to explain that for our audience, you may have a situation where AMI is average median income. So 100% would be what the average person in that area makes. 80% would be 80% of that, or 20% below what the average person makes, 60%, so forth and so on. And so those affordable housing tiers generally range anywhere from 40%, which is, pretty low income, like right at the poverty level, all the way up to 120, depending on, what's going on in a particular marketplace. Could stretch to that, but generally you're going to see things below 100. So
yeah, well said, Joel.
Yeah.
There's again, there's Section 8, and there's the voucher program.
Mm-hmm.
I can tell you that there's differences of opinion as to whether people really care to be part of the voucher program.
Mm-hmm.
I'm of the opinion that as long as it's easy and you get your money, money's money, so I don't care.
Yeah.
As long as the tenants are not tear your place up. But some folks say that the voucher programs can be very complicated.
Mm-hmm.
And that it just becomes a headache. So yeah, there typically an affordable housing deal does have, certainly the low-income housing deals that we work with have a small percentage of voucher tenants.
Right. Yeah, no, that makes sense. And I certainly understand your point. We're actually looking at a deal right now where the Section 8 income is actually very comparable, or even a little bit stronger than the market, which is surprising. You don't generally see that, but that can happen in certain marketplaces. Let me do this right quick. Tom Robinson, an old friend of mine, is on the line here, and Tom's been in the game a long time. But Tom, you got a question for us, for Steve? How you doing today? Thanks for joining. Hey, Tom, come a little closer to the mic. We're having trouble hearing you.
Is that better?
Oh, yeah, that's better.
Okay. Again, hi, Steve. I love this podcast. This is great. I'm an old Equitable guy. So when we started talking about Compass and all the risk-based capital stuff and all that kind of stuff, it perked my ears. But I'm also
Hey, Tom, come a little bit closer to the mic again. You fell away again.
Man, I don't know where the mic is on this thing.
Stay right there. Right
Stay
there.
right there. Okay.
Don't move.
All right. So,
Yeah.
so my question is based on the issue of valuation, right? Right, Steve. Everything we invest in, the issue is whether it's going to go up in value or down in value, right? So now we have a couple of compound issues of interest rate hikes and what the interest rates are going to look like in the future, as well as the AI impact. So what's your thought on future value per asset class?
Yeah, Tommy, that's a great question. I lose sleep over this because my background was an office guy, and not only do I see all of these beautiful office buildings and all of my friends who are developers, owners, and brokers all alike I'm just so afraid for all of them. So let's talk about my humble opinion is that office, everybody's always said the office environment was kind of a bell. And so one side of the bell is all of these fancy new office buildings that have all these fancy amenities and all this fancy stuff, free food, free this, free that, whatever it is. And that's where the tenants want to go, and they're going to do okay. And just about anything outside of that is going to just go to, I wouldn't say go to hell, but just have a real problem. Mm-hmm. I'm seeing that. I don't believe that the fancy buildings are going to not become unscathed either. I do believe that there will continue to be folks coming back to the office, and you will find that certainly, law firms, CPA, call it professional firms, they all have to be in the office. They can't train people outside of the office. It's just doesn't work. I had a long conversation with folks at Deloitte and how they're going to be able to go through COVID and how they were going through COVID. And they said it's going to be a real problem, especially with the next round of hires and how they're going to train them. They have to be in the office. So, okay. So with all of that said, does that mean that we come back at 75% of what market used to be, or 60% or 50%? I don't know. I can tell you that if our economy really continues to grow, we can make that up. But if the economy goes stale, we're going to have some years of some problems. And I can tell you the capital markets are going to be affected, and you're going to start seeing CMBS and some of these banks really, really suffering because of it. And I'm just talking about just from the office perspective. So go back down to retail. Malls are in trouble generally. They're being reconfigured, re-engineered, reimagined for all kinds of things. And I do believe that they've got some headwinds ahead of them. Same with some of the big box guys. Absolutely some headwinds. I do believe that the strip center, the ones that have your dry cleaner and your, hair salon and your Starbucks coffee and sandwich shop, maybe even around a grocery store. I can tell you can get groceries from Amazon, but I can tell you that 90% of times that I go ahead and try to order an apple from Amazon, it's not the way I like it. So I go for it. So I do believe that anchored and service stores are going to probably stay in pretty good shape. Industrial, certainly last mile is hot. Warehouse is hot. Not as hot as it was, but it's still hot. And apartments are hot. We're still way behind the demand and need. I mean, like millions. Certain markets are going to get affected, like anything else. I don't know if you build 100,000 units in Buckhead, you're going to have a problem. But if you build 100,000 units throughout all of Atlanta, you're probably okay. So it just depends on how stupid the developers are as far as, are they last in, and how big do they go? Does that answer your question, Tom?
Yeah, that's dead on, and it sort of mimics my thoughts on what's going to happen. But I guess I always look for the question is, okay, what's the good news? Now that we've heard that, how does this turn around?
It's going to have to turn around a little. There's going to be a correction. There's no way. I mean, look, I'm 61 years old. I've been through 3.5 major real estate cycles, and yeah, I mean, it corrects, and it's going to suck for a while, and then you come back and you figure it out. I think this time with AI and Zoom and all of call it technology, I think that we're in for a little bit, and Amazon, I'd say there was big corrupter. I think we're in for a little bit different correction as to what our world's going to look like, and maybe 10 or 20 years from now. I think it's going to be a little different than it's been over the last maybe 50 or 60 years. The capital markets are going to have, it's funny when I say this, because heck, I remember the 70s and 80s when, interest rates were 21%. We still have a relatively low interest rate environment, but it's really, really high compared to zero. So, yeah. We're okay. We're okay. We're going to have to make these numbers work. Where the Fed, I believe personally, where the Fed screwed up is it just went too fast. It was just too fast. And I think they were scared because of inflation. Take a breather. Let's let things settle down. I also believe that, all of the handouts are $6 trillion that was basically given out. It took a long time for that to get through the markets, to get through the whole economic engine. And I think we're seeing that come to an end.
All right. Well, we appreciate that. That's very good insight. Oh yeah, thank you, Tom. Appreciate that. One thing you don't know about Tom, he used to flip malls. So his question, I was like, wow, I could understand why he's asking that because, to his point, he brings up a good point. What's the opportunity, right? You mentioned about malls being repurposed. There's a lot of things that are going on in that regard. I'll talk to you about some things offline that we're actually involved in related to malls. But, what is the opportunity? And we've had kind of enough time now with this Amazonian world that we're living in to see what might be the exit for malls. And it's probably not coming back the way it used to be, where everybody just runs to the mall. There has to be a different dynamic. But now we're starting to see this with office, right? And what's going to be the new groundswell related to office? Is everything going to become multifamily? Or all of them going to become multi-use? I mean, what exactly is going to happen, when you have 60 stories of office like New York City, for an example. So ways to be seen. And then in your world, are there tax credits that might be available to help you take advantage of some of these opportunities, especially since there is a shortage of housing? So a lot of things to think about.
Absolutely. I mean, and those tax credits will help. And there's a lot of pressure to provide more tax credits and get that program bigger, because they're, pick up a paper anytime, anywhere. And there, every city and every jurisdiction is saying we need more affordable housing. And during this big, real estate run up, I kind of feel sorry for those folks who are basically being pushed out of their neighborhoods because they can't afford to live there anymore. Yeah. Either their buildings are being torn down and a new Class A building is being put up, or the new owners are coming in, or the owners coming in and renovating and doubling the rents. And that's kind of tough. Mm-hmm. So, I love the affordable housing space because from a risk perspective, I think it's going to be sustainable for a long, long time. And I do believe the government is with us to help us, make sure that's going to continue. Joel, you did say something where, and Tom, you mentioned, so where's the play? Where's the opportunity for real estate people? Well, one thing, if I had a crystal ball, I wouldn't be telling you guys.
Good point.
Right. As I said, I do believe that, last mile, I do believe that, strip centers are going to be fine.
Mhm.
I do believe that if you're going to do market rate apartments, you're going to be fine. We don't know much about single family, subdivisions and things like that. I guess, that's the whole different world for us, but maybe fine.
Mhm.
I'm not really in the hospitality space, although our Opportunity Zone Fund owns one hotel. That too is unique. The hotel industry it's not just a hotel. I mean, you can get these huge resorts and, all of these, conference facilities, et cetera, with golf courses and all kinds of things. And then you have the True Brand by Hilton Hotel, which is a limited service hotel. And both of them have their niche. And
Mhm.
both of them could do well, but both of them also have their risk.
Yeah.
So,
Yeah. Valid point. So it's an interesting world. We're looking forward and we're trying to figure this all out. And a lot of it is just waiting and seeing, and then trying to be adaptable fast enough to be able to take advantage of opportunities. So very interesting world we're living in right now. We're pretty much at time. So we'll let you have the final word. Is there anything that you want our listeners to know as we kind of go away from our conversation today? I think it's been a wonderful discussion.
yeah, Joel, I appreciate you and the opportunity. All I can tell you is that I like what Tom said and what you said is that, look, we all just need to kind of put our head down and learn as much about the various asset classes, markets, and the financial markets as well. And you're gonna make some mistakes, but because there's just no way to predict 100% what's going to go on. But go for
it. You know what? There's opportunity in every market, so you just got to figure it out, right? So thank you for sharing that. That's been wonderful. I'm gonna ask you to sit tight for a minute if you don't mind, but we're gonna close out at this point. Roland, you can prepare to kill the live stream as well, but I want to thank you all for being here today. This has been the Mornings with Joel CRE podcast. Very, very exciting and mentally stimulating meeting this morning with Stephen Rothschild. We certainly appreciate him. And we look to have you guys back with us next week for your participation as well. Thank you so much and have a great afternoon. You've been listening to Mornings with Joel, Commercial Real Estate Podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Please check back weekly to hear our upcoming guests.